Here's something wild right now. Americans collectively owe over $1.87 trillion in student loans alone. Not credit cards, not mortgages. Just student loans, and that's only one type of loan out of dozens that exist. So today, we're breaking down 9 major loan types: mortgage, personal, auto, student payday, business, home equity, debt consolidation, and buy now, pay later. And by the end, you'll know exactly how each one works, what it costs, and which ones can quietly wreck your finances if you're not careful. I'm your vault keeper, and this is every loan type explained. Let's unlock it before we go type by type. Let's simplify the whole concept. A loan is simply the bank handing you a big chunk of vault coins right now on the promise that you'll pay it back over time, plus a little extra called interest. That interest is the price you pay for the convenience of having money today instead of waiting years to save it up yourself. Every loan really just comes down to 3 numbers: how much you borrow, called the principal; how much extra you pay, called the interest rate; and how long you have to pay it back, called the term. Change any one of those 3 and the entire deal changes with it. Keep that in mind because it applies to every single loan type we're about to cover. Let's start with the heavyweight, the mortgage. This is the loan that lets you buy a house without having to save up the full price in cash first, which, let's be honest, would take most people decades. Instead, you put down a smaller upfront amount called a down payment, and the bank covers the rest, usually paid back over 15 to 30 years. Here's the twist most first-time buyers don't expect. Early in your mortgage, most of your monthly payment goes toward interest, not the actual house. It's only later in the loan that more of your payment starts chipping away at the real balance. Miss too many payments, and the bank can take the house back entirely, which is why lenders take mortgage applications so seriously, checking your income, your credit score, and your existing debt before approving you. As a personal loan is refreshingly simple compared to a mortgage. You borrow a lump sum of vault coins for basically any purpose: a wedding, a medical bill, debt payoff, home renovation, whatever you need, and you pay it back in fixed monthly installments over a set period, usually 2 to 7 years. Most personal loans are unsecured, meaning you don't have to put up your house or car as collateral. That flexibility is convenient, but it also means the bank takes on more risk lending to you. So interest rates tend to run higher than something like a mortgage or auto loan, depending heavily on your credit score. An auto loan works almost identically to a mortgage, just on a much smaller scale and a much shorter timeline. You borrow the money to buy a car, and the car itself becomes the collateral, meaning if you stop paying, the bank can repossess the vehicle. Auto loans typically run 3 to 7 years, and here's a tip most car buyers overlook. A longer loan term means lower monthly payments, but it also means you pay significantly more in total interest over time, and you risk being underwater, owing more than the car is even worth, especially since cars lose value fast the moment you drive them off the lot. Student loans exist to cover the ever-rising cost of college, and right now the numbers are staggering. The average federal student loan borrower owes just under $40,000, and interest rates for undergraduates currently sit around 6.39%, while loans for graduate students and parents run even higher, up near 8 to 9%. There are 2 major categories here: federal loans, backed by the government with fixed rates and flexible repayment options, and private loans issued by banks or lenders, which can have either fixed or variable rates and generally offer far fewer safety nets if you fall on hard times. Federal loans are almost always the safer starting point, precisely because of those built-in protections. And now, Vault Keeper, we arrive at the loan type you need to be the most careful with: the payday loan. This is a short-term loan, usually just a few $100s, designed to be paid back by your next paycheck, typically within 2 to 4 weeks. Here's the danger: payday loans often carry annual percentage rates north of 300 or even 400%. To put that in perspective, borrowing $300 could mean paying back $345 or more just 2 weeks later. Miss that repayment window, and many borrowers end up rolling the loan over into a new one, racking up fee after fee, trapped in a cycle that's brutally hard to escape. If you're ever in a situation considering a payday loan, it's genuinely worth exploring literally any other option first. A business loan is borrowed money specifically used to start, run, or grow a business, covering things like equipment, inventory, hiring staff, or expanding to a new location. These loans come in several flavors, from traditional term loans with a lump sum and fixed schedule to lines of credit that work more like a flexible pool of money you draw from as needed, similar to a credit card but usually with better rates. Lenders evaluating a business loan look at different things than a personal loan: your business revenue, how long you've been operating, and sometimes your personal credit score too, especially for newer businesses without an established financial track record yet. Here's one that surprises a lot of homeowners: the home equity loan. If you've been paying down your mortgage for years, you've built up equity, which is basically the difference between what your home is worth and what you still owe on it. A home equity loan lets you borrow against that built-up value, receiving a lump sum you pay back over a fixed term, often used for major renovations, debt consolidation, or big expenses. Because your home itself is the collateral, home equity loans typically come with lower interest rates than personal loans or credit cards. But there's a real risk baked in too. If you can't keep up with payments, you could lose your home, which makes this a powerful tool that deserves genuine respect and careful planning. If you're juggling several different debts, a couple of credit cards, maybe a personal loan, a debt consolidation loan lets you combine all of that into one single new loan, ideally with a lower overall interest rate and one simple monthly payment instead of 5 confusing ones. The appeal here is obvious: simplicity and often real savings on interest. But here's the catch: nobody mentions enough. Consolidating debt doesn't erase it, it just reorganizes it. If you consolidate your credit cards and then immediately start running up new balances on those same cards again, you've now got the consolidation loan payment and new credit card debt stacking on top of each other, which can make things significantly worse, not better. And finally, the loan type that's exploded in popularity across the US and UK in just the past few years: buy now, pay later, often shortened to BNPL. You've probably seen it at checkout online. Split your purchase into 4 smaller, interest-free payments, spread out over a few weeks. On the surface, it looks harmless, even helpful, and used responsibly for a single purchase you already budgeted for. It genuinely can be. But here's what a lot of people don't realize: BNPL makes it dangerously easy to stack multiple plans across multiple purchases and multiple retailers simultaneously. And unlike traditional loans, many of these transactions historically haven't shown up on credit reports, meaning it's possible to build up real, meaningful debt that stays completely invisible until it suddenly isn't. All right, Vault Keeper, let's zoom out. Every single loan we just covered follows the exact same underlying formula: principal, interest rate, and term. What changes is the purpose, the collateral involved, and crucially, the risk level if things go wrong. Mortgages and auto loans use a physical asset as collateral, which usually means lower rates but real consequences if you default. Personal loans and payday loans are unsecured, which usually means higher rates because the lender is taking on more risk. And newer products like BNPL are reshaping how borrowing even looks, for better and for worse. Here's your Vault Keeper takeaway. Before taking on any loan, always ask 3 questions. First, what's the total cost? Not just the monthly payment, but everything you'll pay back, including interest over the full term. Second, what happens if I can't pay? Is there collateral at risk, like your house or car? And third, is there a cheaper alternative available to me right now? A loan isn't inherently good or bad, it's simply a tool used with a plan. It can help you build a life used carelessly. It can quietly bury you in debt that takes years to dig out of. So there you have it: mortgage, personal, auto, student, payday, business, home equity, debt consolidation, and buy now, pay later, fully unlocked. 9 different ways to borrow, 1 identical rule underneath. Know exactly what you're agreeing to before you sign. If this unlocks something for you, hit subscribe. Every Monday and Thursday, we crack open a new financial system together, one vault at a time. Stay sharp, stay secured. I'll see you inside the next vault.